Welcome, and thank you for taking the time today to join us for this webinar titled Navigating Changes to IRA Tax Credits under the Big Beautiful Bill Act, or as we call it, OB3. For those of you that don't know me, I am Drew Palmer, Grants Integration Manager for Governor Gordon. The Grants Management Office is housed in the State Budget Department, where I work very closely with our team. So let me introduce a few of our key team members today that are here with us today. With the State Budget Department, we have Christine Immiger, Administrator of the Grants Management Office and a Senior Budget Analyst. Not on camera, we have Diana Cabriales, who is the Deputy Administrator for the Grants Management Office, also a Senior Budget Analyst. And in the background, whom you can't see today, we have various members from our Haggerty Consulting team, so we appreciate them being here. And our special guests today are the accounting firm of CliftonLarsonAllen. Michael DePrima, who is the leader of Federal Tax Strategies practice, Christine DeMena, who's the Renewable Energy Tax Principal, and Aaron Willis, the Research and Development Tax Manager, are all here today. CLA is a large firm of tax accounting professionals in the United States, and they assist Wyoming in many ways. They began working with us under the CARES and ARPA programs and have continued to provide guidance through the Infrastructure and Investment Jobs Act and the Inflation Reduction Act funding programs that have been significant for Wyoming businesses and communities. Before we get started, let's review a few housekeeping items. This presentation will be recorded and will be posted on our website. Please keep your devices muted unless you are speaking, and there will be time at the end of the presentation for questions. So you are welcome to put questions in the Q&A box below, or you may raise your hand and we'll call on you. And finally, please enter your name, title, and your organization or local government that you represent in the chat. And please keep those Q&A and those chats separated. It makes it easier on our end to navigate. So if you are joining us for the first time, let me take a moment to provide some information regarding services that the Grants Management Office offers. Governor Gordon launched the Grants Management Initiative in July of 2024, so we're only a little over a year old. He recognized that Wyoming historically has ranked very low in receiving federal funds back to the state, yet we certainly pay our fair share into the Treasury. The governor specifically realized that in pursuing federal funds, we needed more resources across the state. The Grants Management Office was created and thereby created WYGAP, or the Wyoming Grant Assistance Program, which consists of services for coordination and technical assistance, researching federal and state funding opportunities, grant writing or reviewing of projects, and we also assist with the full grant life cycle of monitoring, reporting, and auditing. We also finally provide services and support services and training. The one thing we will not do for you, we will not tell you what to apply for, but all of our services are free of charge. These services are available to assist state agencies, local governments, tribal organizations and governments, nonprofits, and small businesses, with the intention of building capacity over time and providing additional resources to apply for federal and state grants. The overarching goal is to create a one-stop shop for resources related to federal and state grant opportunities and working to identify stacking and braiding options, including IRA and other tax credit programs and direct pay. And this will help to maximize benefits to the state and local communities. It is the expectation that this effort will assist in laying the foundation for a viable solution in meeting the technical assistance and resource needs of our communities long-term. So why the webinar today? With all of the changes and priorities we are seeing in the transition from the Biden and Trump administrations regarding federal program funding and tax incentives, we thought that this would be a perfect time to invite our tax experts with CLA to share with us what they are seeing moving forward and to answer questions that you may have regarding your projects. So we have a lot to cover. Let's get started. I am now going to turn the presentation over to Michael DePrima to kick us off.
Awesome. Thank you so much, Drew and team, for having us today. Really excited to present on this topic. Excited to be joined by our colleagues, Aaron and Christine. So let's dive in, everybody. And by all means, as Drew mentioned, fire away with questions as we talk through this content. We are really going to scratch the surface today on some very important topics, but really this is a bit of a primer in terms of clean energy and also Section 174 changes coming out of the OB3, as we affectionately call it. This was pretty large legislation, so really we're really just going to be kind of scratching the surface here. So I am sharing my screen. Hopefully you can all see this. If you have any technical issues, let me know. So, all right. So quick background here of the run of show. Um, Christine DeMena is going to cover energy credits in general and really what the Inflation Reduction Act did for energy credits. This was pretty massive legislation we had a couple of years ago. And then we had the OB3 that was enacted here a few weeks ago on July 4th, to be exact, that made some changes to the IRA. So this has been a pretty quickly changing landscape around clean energy tax credits. Energy credits have been around for quite some time, but we've really seen such a flurry of activity between the IRA and now the OB3. So there's a lot to digest here. And then another major change we had coming out of this legislation was regarding R&D or R&E activities, research and development or research and experimental costs. We kind of use that interchangeably. Really big impacts due to the recent legislation, mostly taxpayer favorable. Aaron's going to cover those at the end. And of course, we're going to set aside some time at the end to field any questions that you might have that we don't address throughout the course of the presentation. So with that, I'm going to hand it off to our colleague, Christine DeMena. And Christine, I'll be controlling the slides, and it's all you.
Thank you, Mike. So as mentioned, the Inflation Reduction Act was really a landmark piece of legislation, creating huge opportunities for investments in clean energy. In particular, creating new monetization options for both tax-exempt and taxable entities. The IRA was generally effective as of January 1st, 2023 through 2033, and Mike will later talk about how that end date may have changed for some of the credits under the OB3 Act. Under Section 6417, that's what we call the elective pay side of the house, or direct pay. And this is applicable for those tax-exempt entities. So any regular nonprofit, state and local governmental entities, all different levels, all types of agencies, tribal governments, and rural electric cooperatives. And under this section, these entities now have a way to benefit from their investments in clean energy by actually receiving a direct payment back from the IRS for a portion of their investment. So really an opportunity that tax exempt and state and local governments rarely get the chance to benefit from these federal incentive programs. Under Section 6418, that's what we call the transferability side or the transferability option. That is for-profit organizations, and that allows a for-profit to buy and sell these energy credits for cash. And the reason that this is a really great opportunity for them is many for-profits might not have a tax appetite for these credits. They might not be able to use them based on their taxable position. Or they may want to get some of these credits to help their taxable position, but don't have those investments in the energy. So that's where they're able to buy and sell these credits to other entities and still benefit from the program.
Yeah, I think it's worth noting, everybody, that this was pretty unprecedented, the ability for tax exempt, including governmental organizations, to get direct refunds of these tax credits. We never had anything like that in the tax code. And then also on the transferability side, again, pretty unprecedented. So the IRA was really unique in creating these monetization options for all sorts of organizations investing in various clean energy technologies.
So there's a bunch of different credits under the IRA, and you can see there's a full list of them. We're going to focus on a few of them today in this presentation. The first one on the list, Section 30C, which is the alternative fuel refueling property credit. We'll also take a look at sections 45 and 45Y, so that's the electricity produced from renewable resources, and the clean electricity production credit. We'll talk about section 48 and 48E, that's the energy credit and the clean electricity investment credit. And then section 45X, which is the advanced manufacturing production tax credit. So let's start with the investment tax credit and the production tax credit. So for certain energy property, you can claim either the ITC or the PTC. You cannot claim both. Examples of some of the eligible property under these, under the ITC and the PTC include items such as geothermal HVAC, solar, and that solar can be ground mounted, roof mounted, carport, so all different sorts of solar, wind energy, biogas, combined heat and power systems, hydropower. So all of those types of property fall under the ITC and the PTC. The investment tax credit under sections 48 and 48E is based on a percentage of the eligible property. And the distinction between 48 and 48E, section 48 was for property placed in property prior to 2025, and then the section 48E generally is for property 2025 and later. There are going to be some cases where you are picking which credit you're filing under. The credit for this starts at 6% of the eligible property, but that can be increased to 5%, 5 times multiplier to 30% if you can meet either prevailing wage and apprenticeship requirements, your construction started prior to January 29th of 23, or your system is under 1 megawatt. So for example, if you have a solar array that's 500 kilowatts, that's under 1 megawatt, and you automatically start at that 30% base credit. There are also some other bonus credits available if you're located in an energy community, that's potentially another 10%. A low income community could be 10 or 20%, or if you're meeting domestic content requirements, another 10% as well. For constructions beginning in 2024, projects that are over that 1 megawatt threshold have to meet domestic content to avoid either a reduction in the credit or a complete removal of the credit to zero, and that's going to be depending on when the construction started. So it is a bonus credit, but also there are some penalties if you fail to meet it and you're required to. So it's just really important as you are planning your projects to know upfront, what is the size of the system? Do you need to meet prevailing wage and apprenticeship? Do you need to meet domestic content or qualify for an exception? And to get all of those things done in the planning phase so you're not surprised at the end.
Yeah, one of the other critical decision points early on is deciding whether you're going to go after the ITC or PTC. So, as Christine mentioned, it's one or the other. So, there's a lot of planning that you will typically go through to determine, hey, is your wind project going to be better off claiming the ITC or PTC? And then, as Christine mentioned, looking at those bonus credits as well. We don't really dive into the bonus credits today just for the sake of time. However, they're pretty significant. They can really add quite a bit of additional benefit on top of these base credits. Prevailing wage and apprenticeship, it's kind of a bonus credit, but it's a little bit different in that it really is it's changing the base credit rate, I'll say. It's a big deal. Now with PWA kind of in the water now, a lot of projects are having to comply with it, and it can be very challenging. So if you do have any projects where PWA has to be tracked, you're probably experiencing some of those pain points. There's a lot of coordination across the project owners, general contractors, and subcontractors, but generally it's well worth it because it'll give that 5 times multiplier to that other to the base credit of 6%.
Oh, you want to pop back for a minute?
Oh yeah, sorry about that, Christine.
No, that's okay. Just to touch on the production tax credit, that one is designed to encourage the production of renewable energy. So that incentive is based on production, and you can claim that annually, generally up to 10 years from the placed in service date. And then for both of these credits, if you're a state and local government that has never had to file a 990 or a 990T, you would be claiming these credits on a Form 990T. That's due on the 15th day of the 5th month after the end of your fiscal year. You do have to timely file for these credits. You can't go back and amend a year where the filing deadline has already passed. So just really important to know your dates as well.
Yeah, absolutely. And we do have a question here. How is the ITC impacted after the OB3? We're definitely going to cover that in some detail here in a couple slides. So hang tight. We'll get to that here shortly.
Yep.
Want me to advance, Christine?
Yes, please.
Okay.
So then Section 30C, the alternative fuel refueling credit, I'm getting better at saying that quickly. That's really for the charging infrastructure. So if you're putting in charging stations for your electric vehicles, that's what this credit pertains to. Similar to the ITC, PTC starts at 6% of the or similar to the ITC, starts at 6% of the qualified property cost. If you are able to meet prevailing wage and apprenticeship requirements, you get that 5 times multiplier up to 30%. That is the only way to get to the 30% is to be in compliance with PWA, unless the project is so small it may not require all pieces of that. The max credit is 30% up to 100,000 per unit. The important thing to know here is that you have to be in a certain tract in order to be eligible for this credit. There is a map where you can go and type in the exact address, latitude, longitude of where your planned charging infrastructure is going. If you are in the shaded area, you're good. You're eligible for the credit. If you're outside that shaded area, you're out of luck, and it literally can be on the wrong side of the street. So really important to make sure you're aware if you are putting in charging infrastructure, if you're going to be able to claim this credit or not. Oh, did you have something, Mike?
No,
Okay.
sorry, Chris.
No, it's okay. And then just I've seen a lot of cases where you know, they weren't really thinking about the prevailing wage and apprenticeship piece in relation to this credit up front. So a lot of the times it's defaulting to that 6%. So again, just upfront planning if you're hoping to get 30% of the qualified property and making sure you're complying with PWI.
It's worth noting, everybody, that a good chunk of the state of Wyoming is in designated zones for Section 30C purposes. As we'll see, though, this is one of those credits that is slated for pretty early termination under the OB3. I can take this one, Christine, if you'd like.
Sure.
So Section 45X, this one was brand new under the IRA, and I'll tell you, it's kind of like the golden egg coming out of the legislation. I don't think we realized when it first hit the books how powerful this credit was going to be. And this really is a manufacturing credit. It's for the manufacturing of various clean energy components, wind components, solar components, battery. There's a lot of focus on battery storage under the Inflation Reduction Act, which was largely retained under the OB3, and with good reason. You know, we're creating this renewable energy, you need to store it. So a lot of provisions relating to battery technology. But this is really incentivizing the producers of these various clean energy components. Obviously, they have to be made within the United States. And the amount of the credit really varies depending upon what type of component you are manufacturing. Some of the products are tied to weight, and it's a certain multiplier based upon the weight. Some of them are based upon direct cost. For example, there's a lot of different critical minerals that are incentivized under Section 45X. Those are typically going to be some percentage of your direct cost going into the production of these items. What's really interesting about this credit is you've got 3 options in terms of how you want to claim it as a for-profit entity. So one, you can apply it against your tax liability, which, you know, that's generally true of all tax credits. If you've got tax liability to absorb the credit, you can use it against your tax liability in any given year. You can also, with this one, you can transfer it under that provision that Christine mentioned, that 6418, or refund it even if you're a for-profit company, which is unique because most of the credits that are refundable under the IRA are only refundable if you're a tax exempt, as Christine mentioned, a nonprofit or a state and local government, etc. But this one's a little bit unique, and they said, hey, even for-profit corporations, partnerships, etc., will be able to get a dollar for dollar refund of this particular credit. What we've seen for the most part, and we as a firm are doing a lot of Section 45X work. It's a pretty powerful credit. Most of the clients that we work with that are claiming 45X are selling it, usually on a quarterly basis. And this is a really solid cash flow planning tool. So if you've got pretty steady production of, let's say, wind turbine blades throughout the year, you can actually slice this up into quarterly tranches and sell it in the market, quote unquote, on a quarterly basis. So there were some changes to this one that we'll cover here under the OB3. But for the most part, this one's going to be around for a while. And I know there are certainly some manufacturing companies in Wyoming that have benefited from this credit. But it is really one of the most lucrative credits that we've seen coming out of the IRA. Okay. And I think I'm taking this, right, Christine? All right. So here is a very brief snapshot of some of the major changes going into the OB3. And a little bit of background here, there was a lot of chatter around clean energy credits with passage of the OB3. It went through the House, went through the Senate, and there were varying degrees of modifications to these tax credits. I think there were certainly some winners and losers here from a tax credit perspective. By and large, though, I think it could have been a lot worse. You know, we still have a lot of opportunity post OB3 to claim credits, and very, very noteworthy, direct pay, that refund opportunity we've mentioned, and transferability were untouched. Now, they are impacted to some extent by the underlying credits and some of these new foreign entity of concern rules that we'll touch on shortly, but by and large, transferability and elective pay were left intact post OB3. So that was a great thing coming out of the legislation. The biggest change here that we saw was really to wind and solar ITC and PTC. And I think one of the attendees had this specific question. So wind and solar was kind of there was a bit of a bullseye on the backs of wind and solar credits here under the OB3. And you can go back and forth in terms of the why behind it. But when you look at it realistically, wind and solar are some of the most mature renewable technologies, right? And then you also have the pay for impacts when you're trying to pass a bill like this one was under budget reconciliation. So this was probably the most impacted credit that we saw coming out of the legislation. And the termination or the acceleration here is really 2027. It was kind of the key date here. So what the legislation specifically said, and it's worded a little bit oddly, but basically said if your construction starts after July 4th, 2026, then your place in service date for your wind and solar project has to happen by the end of 2027. If not, you're essentially going to lose out on the credit completely. If you are prior to that, meaning your construction started prior to that July 2026 date, then you have a longer window, really the original window under the IRA, which will typically take you out to 2030, maybe 2031. So it's definitely shortening the window of time that you have to get your solar and wind projects completed and for construction to start on these projects. Now, construction start, or beginning of construction as the tax rules refers to it, is kind of its own subset of law under clean energy credit provisions. And there's been, believe it or not, a ton of guidance from the IRS regarding when does your renewable energy project start. We've had a series of safe harbors based upon cost, based upon physical work. And it's been a fairly convoluted area. It sounds like it would be simple on the surface, like, hey, this is when your project starts, but it's actually a fairly complicated analysis. So in conjunction with the accelerated termination of wind and solar credits, The president, shortly after OB3 passed, issued an executive order instructing Treasury to rewrite the beginning of construction rules specifically for wind and solar. So we had that provision. We're going to cover that here in a couple more slides. But it was a major shakeup in the world of wind and solar. So not only are we seeing an accelerated termination, we're also seeing the rules basically rewritten for when your wind or solar project actually starts construction for tax credit purposes. So this was probably the biggest change coming out of OB3. We also had some accelerated terminations for the EV related credits. So Section 30C that Christine mentioned and the EV charger credit, that one is getting is repealed for property being placed in service after June 30th, 2026. The other big one is Section 45W. We didn't really cover that in detail, but this is really an EV credit. There is also, as you might know, a consumer counterpart to this EV credit. Section 45W is the business-related EV credit. Usually it's 7,500 and go up to actually 40,000 in credit for larger vehicles. But this one has the quickest termination, and that is at the end of this month, actually. So if you are interested in electric vehicles, now is the time to go buy them because this credit is going away completely at the end of September of 2025. We also have Section 45U, and this is for zero emission nuclear projects. Honestly, we don't see a ton of nuclear, but it is one of those technologies that legislation is trying to really emphasize and incentivize. This one, fortunately, was left pretty much intact. And as you probably are aware, there are some very interesting nuclear pilot scale projects within the state of Wyoming. So this one was pretty much intact. And oh my goodness, I'm sorry, I just noticed a typo there. Original termination date of 2023. That should not be 2023. I think it's actually 2032. I will confirm that. I apologize for that little slip up there. But this one kept its original termination date, which again is not 2023. It's multiple years beyond that. So apologies for that little hiccup there. We also have the clean hydrogen credit, Section 45V. This one is terminating for construction that starts after 2027. 45X, we mentioned, this is the manufacturing credit for different solar components. We actually had a nice little surprise under the OB3 where they added a new critical mineral to the list, which is probably relevant for state of Wyoming, and it's metallurgical coal. So that was added to the list of critical minerals, and that one is based on I think it's 2.5% of your direct cost to produce your coal product. And then we have the credit under 45X specifically for wind components. That one was accelerated in terms of termination to 12/31/2027. So some good, some bad with 45X. The biggest change in terms of early termination is for wind components being manufactured. We also have Section 45Z. Not going to cover this in a lot of detail, but this is a biofuel credit, covers ethanol, things like that, sustainable aviation fuel. Actually extended the termination under the legislation to 2029. There are some feedstock restrictions though for biofuels that are being sold after 2025. So need to see where your feedstock is coming from for purposes of the 45Z credit. So I know that was heavily condensed, kind of rushed, but this is kind of a big picture snapshot of some of the big changes to various credits under the OB3. And again, I apologize for the little typo.
It
We
is
just noticed.
2032. You're correct.
It's so I
2032.
fat fingered and got them reversed. Thank you,
You're
Christine. We
welcome.
will certainly update those slides and recirculate. Okay. So I mentioned beginning of construction guidance and how important this is for wind and solar projects now. It's always been very important for renewable projects, but now it's really critical in the context of solar and wind. So as I mentioned, President said, hey, Treasury, you need to issue new rules. So there's no gaming the system, right? So as we look at wind and solar projects and qualification for various credits, This is the new test that we really need to follow to determine when the project starts. So it was we had a notice, an IRS notice issued in August 15th to be exact of this year, and it kind of rewrote the rules. As I mentioned, there's been a lot of guidance from the IRS over the years on this particular topic, and they kind of revisited some of the rules and left some of it intact, but largely rewrote most of the book here for BOC, beginning of construction purposes. So the big takeaways here for your wind and solar projects are: one, physical work is really the primary method for establishing beginning of construction for wind and solar. Now, what do I mean by that? Historically, there were two different ways to safe harbor a project. Physical work, basically, when is that shovel getting in the ground? When is your project actually starting from a physical construction perspective? Or once you incur 5% of the qualified project costs, we call the 5% safe harbor. This one was typically what we saw for safe harbor purposes. And Christine, tell me if you disagree there, but I feel more often than not when we see a project that's safe harboring, it tends to be using that 5% safe harbor test. And
Absolutely. Yep, that's pretty
yeah,
fair.
and I think the administration particularly did not like that. I think they viewed it as, subject to abuse potentially, kind of gaming the system, spending a whole bunch of money, and then a project really not moving once you safe harbored it. So they're really trying to crack down on that. So they took away, under this notice, the 5% safe harbor test for the most part. The big exception here is that 5% safe harbor is still available for quote unquote low output solar projects, which is 1.5 megawatts or less measured on an AC basis. So if you're under that 1.5 megawatt threshold, you can still use the 5% beginning of construction safe harbor. If you're, oh, and keep in mind, only for solar, there's no counterpart to wind. So there's no, 1.5 megawatt threshold for a wind project, only for solar. So 5% is gone, and physical work is really the primary factor now to gauge whether construction has started. The notice does go through, it's actually fairly helpful, a whole bunch of different activities that count for physical construction and those that don't count, makes distinctions between kind of preliminary work, site work, engineering work, and then actual construction. Also covers a few different areas like third-party contracts. When does work start if you are under contract with a manufacturer for equipment or a GC, etc. Really important theme, though, in the guidance is that you really need to maintain a quote unquote continuous program of construction. So once you start that physical work and BOC is kind of met, you have to continue on with the project. They don't want projects just lying dormant once you safe harbor it, right? Couple other areas that we really will not get into in detail, but the notice talks about, okay, what do you do in the case of a project retrofit, property transfer? So it's fairly common in the clean energy space that you might see a project sold to a third party before it's even completed. It covers that as well, and what the impacts are for BOC, and then also project aggregation. In other words, maybe you've got multiple solar projects on the same site. Do you have to aggregate those to measure whether BOC has started? So pretty important notice here. Really is shaking up the industry. And what we're going to see now, what we're already starting to see, is a lot of wind and solar developers are scrambling to meet these new safe harbor standards. Okay, last one I'm going to cover before we kick it over to Aaron is foreign entities of concern. So this is a new theme under the OB3. FIOC, as we're referring to it, doesn't exactly roll off the tongue, but that's the acronym most folks are using. So FIOC. The whole goal of this is to get non-US sources out of clean energy and out of the supply chain, in short. In particular, there are certain countries, like China, for example, that are kind of on the bad country list that could really throw a wrench in your project eligibility here. So really beginning in 2026, this FEOC is kind of straddling all aspects of clean energy projects. And it applies really in two different contexts. Whether you, as the project developer, for example, have certain impermissible ownership levels by one of these entities of concern, or if your equipment, your supply chain has quote unquote material assistance from certain countries that are on this FEOC list. So we're really scratching the surface here, but this is going to fundamentally change how developers are funding projects and also how they are procuring their supply chain for these projects. That said, we definitely need more guidance here. They gave us the basic framework in the statutes, but undoubtedly, Treasury, the IRS are going to issue guidance here, further refining what it means to have assistance from a FEOC. What are those impermissible thresholds, et cetera? We're already seeing this really kind of permeate, though, the world of clean energy tax credits. Interestingly, I mentioned we mentioned transferable tax credits earlier. This is becoming a pretty significant point already in due diligence when we're working with buyers and sellers of tax credits. They want to understand whether the sellers, for example, have any FEOC concerns. And also, there will come a point where any FEOC type FEOC control entities might not be able to purchase tax credits or sell them. So it's really going to have some pretty broad implications across clean energy and clean energy tax credit transactions from a transferability perspective. It does apply to certain select credits. Noticeably, it doesn't apply to Section 48. So Christine mentioned Section 48 earlier, and like geothermal, for example, we do a ton of work with geothermal. That is under kind of the quote unquote old framework of Section 48. FEOC doesn't apply. So first things first, before you start doing a huge FEOC analysis, need to figure out whether it applies to the particular tax credit that you are going to be claiming or potentially purchasing. But again, really big change here. This is something that's going to have a fundamental shift in terms of claiming and also transacting renewable tax credits. Okay, that was our whirlwind tour of clean energy changes under the OB3, and I'm going to briefly touch on some very important changes to depreciation, positive changes, and then Aaron's going to step in and take us home with the changes to research related expenses under the OB3. So bonus depreciation, we all know it and love it, and it is back, and it is kind of back in a big way. It's essentially permanent. So we have 100% bonus expensing, and that is for property that's acquired and placed in service after 1/19/2025, excuse me. They tied this basically to the president's inauguration day. So this is a really good thing. So especially companies that are capital intensive, a lot of equipment purchases, etc. Bonus depreciation is a really powerful tax planning tool, and it is back. So historically, bonus depreciation has phase downs. You'll have 100% for a couple of years, then it'll phase down to 80%, 60%, etc. The way it's crafted right now, it's basically 100% bonus indefinitely. So really good thing. We also had a really interesting new provision of, new class of property added under the legislation for qualified production property. So think of manufacturing facilities. This property now is potentially going to be eligible for 100% expensing of the real property. So usually bonus depreciation applies to your personal property, right? Equipment, things like that. But this new QPP category is basically saying for your production floors, for example, you actually might be able to expense all of the real property itself. In other words, the structural components. So this is a really big deal. It's not indefinite like bonus depreciation. There is kind of a finite window of time here to go after QPP, but we actually didn't see this one coming. It was a pretty significant change, and a lot of manufacturing companies are very interested in this provision. And then last thing I'll mention here is Section 179. This is expensing of personal property. We did have that increase to 2.5 million for property being placed in service after 12/31/2024. So that's a good one as well. And with that, I am gonna kick it over to Aaron. And Aaron, I got the slides, and it's all you, my friend.
Perfect. Well, yeah, so over the last 3 tax years, companies that are performing research and development have been required to capitalize that research and development for 5 years if the R&D or R&E, research and experimentation, was being done inside the US, and for 15 years if it was being performed outside of the US. So under the OB3, they did fix this, if you want to call it that, to allow for expensing of U.S. R&D again. So they created a new section under Section 174 that allows for full expensing of U.S. R&D. There is no change to the foreign aspect of that. So R&D or R&E being performed outside of the U.S. is still going to be subject to capitalization and then amortization over a 15-year period. One of the other things that's in this bill is that it allows companies that have averaged less than $31 million of gross receipts from 2022 to 2024 to have retroactive treatment of this. And we'll talk through kind of what that looks like in a little bit more detail on the next slide. Hold on, Michael, sorry, I wasn't quite done there. So one of the important things to know is that this 174 has never really impacted the R&D tax credit. They use the same definition of R&D basically. However, over the last 3 years, there was an option to claim a gross credit, basically just that you weren't allowed to take the credit and the deduction. Since you weren't taking a deduction anyway because of the capitalization, the R&D credit was increased by a little bit over the last 3 years. That's going away again. We're going to go back to the old rules where you will have to either add the credit back to expenses or take the 280C haircut. And then to just briefly touch on 59E, the companies that are in AMT, the pass-through entities that are in AMT, the passive owners may still be subject to amortization. That's a rule that came back, and that's actually over a 10-year period. So kind of covered this, but the way it's going to work from a mechanical perspective is on the 2025 tax return. You can make an election to deduct. It's considered a method change. However, from a Rev Proc that came out a couple weeks ago, that will just be a statement that's attached to the return, not necessarily a 3115. You can also elect to continue to capitalize R&D expenditures. It can't be less than 60 months, and then that amortization will start when the benefits of the R&D first start to be realized, or you can start amortizing immediately, but it's going to be over a 10-year period, and that is just an election, not a method change. So that gives us several options for companies. For companies that are under that $31 million threshold, that's the meaning of a small business, so must be a small business taxpayer. There is an election to make this retroactive. That can be done a couple of ways. One, if you haven't filed your 2024 return yet, which should just be C Corps or maybe fiscal years, you can make that election on a timely filed 2024 tax return. Again, it's a statement that will be attached to the return, or there's a 3115 that you can file. Well, I'll stick with option one since this does say amend prior year returns. So you can file that statement and then amend prior returns to get a refund on any taxes you may have paid because of the add back to income that was this capitalization of 174. As I mentioned on that first slide, though, if you do elect to do this and amend returns, you are going to have to take a reduced R&D tax credit if that's something that was also claimed on that return. And it could adjust, it could have farther ranging impacts than just the 174 and the R&D tax credit. Effective tax rates could change because of the 199A deduction or 163J. Your NOLs are going to be impacted, and then various states might be treating it different ways. And so amending returns from a cost perspective could potentially add up. The other option available to small businesses, maybe Michael, we stay on that first slide here because I don't see it listed, is that you can file a 3115. A small business can file a 3115, which is an application for a change in accounting method to deduct all of those expenses on the 2025 return, potentially avoiding the amendment option if either the R&D tax credit was not claimed or the 280C election was already made. So now we can go to the next slide. For companies that aren't small businesses, or for small businesses that maybe don't want to amend,
want to
the
amend.
hassle of amending is too much. There are two other options. The first option, if you want to call it that, is just to continue as things go, allow those costs to continue to amortize over the remaining 5-year life for the US R&D. Or option two is you can elect to deduct all of those unamortized expenses, so the expenses remaining as a deferred tax asset on the 2025 return. The benefit of that is there's no amended returns required, and there's no adjustment that needs to be made to the R&D tax credit. So you get to keep a larger R&D tax credit. Or you can elect to deduct 50% of the unamortized costs in 2025 and 50% of the unamortized costs in 26. On its face, I think this seems like oh, well, why wouldn't we just deduct it all in 2025 as opposed to splitting it between 2 years or even letting it amortize out? And to that, I just say that I think there's a pretty significant modeling exercise that can happen here. Um, because net operating losses can only be used to offset up to 80% of net income. If you're a company that operates at around break even, or you don't have huge profitability each year, there may not be a whole lot of benefit to come from deducting a pretty large number for however much might have been capitalized in prior years all in one year and just converting it from amortization to an NOL. It might make more sense to allow it to continue to amortize where it is kind of above that line. It's a deduction prior to taxable income, where the NOLs, which again can only offset 80% of taxable income, can come after that. And so I would just advise to meet with your tax preparer on that. The answer may not be the answer for what's best for you and your business may not be as simple as what it seems on its face. So I mentioned that a RevProc, or revenue procedure, came out a couple weeks ago. It addresses this, gives us a little bit of guidance on how the IRS is going to be treating this. So I mentioned that you do have that option to file a 3115 if you're a small business and deduct everything in 2024. Rather than amending returns, you may still have to amend again for the R&D tax credits to fix the 280C thing. But I think that covers that piece. I think I covered the rest of what was on that slide. So, like I
Yeah.
said, there are practical considerations here. Amended returns cost money. If you file in lots of states, that can add up pretty quickly. If you're going to amend to try and get refunds, the IRS has not been historically very fast at turning around those refunds. There are potential impacts to estimated taxes. So we have advised a handful of clients that I know it causes you to pay more taxes right now, but you might as well just capitalize on your 2024 return. Um, Make smaller estimated payments in Q3 and Q4 for your 2025 return, knowing that you have that huge deduction coming. And maybe then in that case, the cash flow issues aren't as significant. And then, like I said, I would always recommend to start with consulting with your tax preparer. There are a variety of issues to consider before making the decision on which of those options is best for you.
Yeah, the change to capitalization of R&D expenses, which went into effect 2022, was one of the most painful law changes we've ever had to deal with. It really hurt companies. So we are very happy that it was fixed, but leave it to Congress. It's not an easy fix. There's different options, different modeling you should still go through. And as you can see, it's a little bit complicated, but all in all, this is a really good thing, but want to make sure that you're analyzing your different options to get to the best result from a expensing standpoint. And with that, here's our contact information. Again, we'll fix that little hiccup here in the slide and recirculate this. And if you have any questions for us after the presentation, by all means, reach out. We'd love to chat with you. And Drew, that's the presentation we had. I think we got about 10 minutes or so for Q&A.
Fantastic. Michael, Christine, Aaron, thank you so much. That is a lot of information to absorb in 1 hour. So I'm sure that there's going to be more questions. Thank you for that presentation. Christine Immiger. So she's going to assist me with questions for the last 10 minutes of this session. And I think we did have one in the Q&A, Christine.
We did. We also got one in the chat very, very early on. So I'm going to present this one first because that was kind of the tail end of the conversation that CliftonLarsonAllen covered. We had a question come in. How was ITC impacted after the Big Beautiful Bill OB3, specifically with the phase down schedule, FEOC and FEOC requirements?
Yeah, absolutely. And we touched on that, Christine. And the biggest change to the ITC world was the accelerated termination for wind and solar projects. And that also led into some major changes around beginning of construction, how you determine when these projects have started construction for tax credit purposes. So wind and solar, the most impacted provisions under the OB3. And then in terms of FEOC, we covered that a little bit, admittedly very high level, but that is going to really change several different tax credits, not just the ITC and PTC. There's, I think, 6 credits that are impacted by this new foreign entity of concern framework that the OB3 enacted. So it's probably going to be more of a 2026 issue due to the effective date of the FEOC rules, but we are anticipating it's going to have a major change in project qualification and tax credit claims.
Thanks, Michael. Christine, more questions. I see we have a couple in the Q&A.
Yes, we actually do, and it's right on track with what Michael just said. From a local government perspective, we have a question. For a local government with a tax year starting on 7/1/25, on what date did the new FEOC rules kick in? I'm going to start there because it's a multi-part question.
Mm-hmm.
I can start with that, Mike. So as Mike said, it's for tax years beginning after the date of enactment, which would be July 4th. So if you were looking at that for this particular tax year starting, it would be starting 7/1/2026. However, there are certain clauses in the FEOC rules, one that talks about the material assistance piece that does reference construction beginning on 1/1/26. So I think we're still trying to nail down all the little pieces for that. In this particular situation, we literally were just talking about it last night, but when they do release some more guidance on FEOC, we should hopefully have a much clearer understanding. And Mike, I don't know if you want to add to that piece at all.
No, I think you covered it, Christine. It is it's an area with governmental entities that typically don't have a quote unquote tax year where we think some guidance is going to be issued.
Thanks. So second part to that question, are the FEOC rules only for projects larger than 1 or 1.5 MW? Or does it apply to smaller projects as well? They have a specific instance. This local government has a small rooftop project planned on a building with an estimated certificate of occupancy in June of 2026.
Christine, you want to take that one?
Sure. Yeah, it's not based on project size for the FEOC rules. And in this particular case, I think it'd be important to know, are they establishing beginning of construction prior to 1/1/26, or will that be after? Because as I mentioned, as we dig into some of the different pieces, if that material assistance piece does apply for construction beginning January 1st, 26, and regardless of your tax year, then you certainly would want to consider that. But we do have a little bit of time to hopefully get some of those answers.
Great. I think we will reach out to this person and make sure that they get in contact with your team so that they can have their specific questions answered. There is another question. Just generally, how do these compare to tax credits, etc., for traditional fossil fuels, oil, coal, and gas?
I'm sorry, Christine. Can you say the last part of that again?
Yes. So how do these tax credits right now compare to the traditional ones that we have for oil, coal, and gas?
There are still many provisions in the tax code that encourage traditional, fossil fuels, everything from depletion to intangible drilling costs, preferential treatment. So renewable credits are kind of their own creature. You really don't see any overlap with the oil and gas type provisions. I will say the amount of credits available for different types of technology and whatnot probably more robust on the renewable side, but it's hard to compare because it's not necessarily apples to apples. For example, you don't see the sort of energy generating tax credits that we see for solar, for example. There's really not a good analog on the fossil fuel side of the house. So I hate to give a non-answer, but they're pretty different creatures within the tax code. And just to be clear, though, to my knowledge, the OB3 really didn't change any of the incentives or preferential treatment that's still out there for oil and gas type activities.
Thank you very much, Michael. We also have another one, and this is about the 1.5 MW. Can you please talk more about the implications for solar projects less than 1.5 MW AC that still qualify for the 5% safe harbor?
Yeah, so the distinction here, if you're under that 1.5 megawatt threshold, you are able to use that 5% safe harbor. So you've incurred at least 5% of the project cost, and that can help establish your beginning of construction date. If you were over that threshold, you'd have to use that physical work test to establish the beginning construction date. Any size project, regardless, you're still under that. If you don't start construction by July 4th of 26, you have to be in service by the end of 27. So that piece doesn't change. It's just how you establish your beginning of construction. You have an additional option.
Thank you,
Christine,
Christy.
I think we have time for one more question. I think there's one more in the chat.
There is. This is a multi-part one, so I apologize right off the bat. Is it safe to assume that if a project begins construction or meets safe harbor requirements before January 1/26, that it would not be subject to FEOC requirements for solar projects?
Christine, you want to take that?
Yes. Yes. Yep. I would say yes. If you're before that date, then you're good under the current rules, unless something comes out with additional guidance that tweaks anything. That's our understanding.
Great. Well, that is it for the questions that we received in the Q&A. There were some follow-ups, and for those individuals that provided follow-ups, we can send an email out to you directly from the SBD Grants resource account, and we can make sure that your question either got answered or we can put it into writing for you so that you can revisit the answer. I do want to express this is a lot of information. It's new. Everything is rapidly changing. That is why CLA is able to provide us so much value when it comes to this topic, and we are very grateful and appreciative to have them as a collaborative partner at the Grants Management Office.
All right. Thank you. Let's go ahead and wrap this up. So much information, and I know there's going to be more. So for those of you that didn't get your questions in, we will capture those. We will try to get back to you. And don't be surprised if we have more targeted and focused webinars with CLA. So on behalf of the governor, thank you to our participants at CLA, and our team sincerely appreciates your time this morning for tuning in and talking about your individual projects. I do want to just make 2 notes. One, the Grants Management Office and our team with Haggerty did a review of the One Big Beautiful Bill Act, OB3, and we do have a grant opportunity and impact analysis that is on our website. So please go to that. Because it was so big, we really broke it down into 5 areas: rural healthcare, energy and natural resources, emergency management and wildfire response, housing and community development, agriculture and rural economic development. We'll also be looking into some more specifics for our Wyoming Office of Homeland Security and funding opportunities that come through them as well. So please look. We've also just recently sent out our newsletter. You can find that on our website. And if you'd like to be on the distribution list, you can just let us know, just email us. So I want to emphasize the delegation, our governor, our federal partners, our state agencies, and the Grants Management Office all stand ready to assist and provide you the resources that you need to be successful in your communities, nonprofits, and small businesses, because that's what makes big, wonderful Wyoming the place that we all want to live. Let's remain vigilant and working together to invest in Wyoming and to promote stronger and more vibrant communities. Thank you for joining us today.
Thank you, everybody.
Thank you, everyone.